After last week's incredible results, Target's clearly back, and maybe it's better than it's been in years. Keep in mind, last October, this stock was at the tail end of a brutal 2-year collapse. That took it down 62% from peak to trough. Target seemed lost, maybe even broken. It was just one problem after another. First, the stock pulled back from its COVID-era highs, given how much this essential retailer had rallied during the pandemic. Then in 2022, when the world went back to normal and consumers changed their shopping habits, Target was caught flat-footed, having double-ordered lots of the wrong inventory. Then they had to discount that stuff heavily to get it off the floor, which led to a severe earnings hit. Plus, like virtually everyone else in retail, they had to contend with high levels of theft. But I've always been a believer in CEO Brian Cornell's ability to turn things around, and he started truly turning things around last November. In fact, from its lows last October to its highs on April 1st, Target rallied almost 77%. Even then, though, the company wasn't truly reporting good quarters. It was giving you better than feared results that surprised to the upside. Plus, the stock peaked in April, and from there through early this month, the darn thing was a slaughterhouse. Wall Street got very worried about lower-income consumers, and it didn't help that Target reported an earnings miss in May, with management issuing tepid guidance for the next quarter. After one final leg lower during this meltdown early this month, the stock finally found a bottom in the low 130s, down 27% from its peak in April 1st, also down 7% for the year. At that point, Wall Street clearly wasn't willing to give Target the benefit of the doubt. There was a ton of skepticism about this one, even if, like me, you believed in Brian Cornell's ability to turn things around. It certainly didn't feel like a turnaround stock. But when Target reported last Wednesday, the results were so strong that they changed everything, causing the stock to jump 10% in a single session. At this point, I am willing to call it. Target is back. Why? First off, the company delivered 2% same-store sales growth when the analysts were only looking for 1.1%. Now, this was their first quarter of positive comps since the end of 2022. More important, the entirety of that gain came from higher traffic, up 3%. None of it came from pricing. Prices were lower. That matters. At the same time, Target's online business is booming. Digital comparable sales up 8.7%. Their same-day services saw double-digit growth, with drive-up purchases and same-day delivery for loyalty members growing in the mid-teens. Brian really liked that when I spoke with him. That matters because when Target was lost in the wilderness for 2 years, there was a widespread sense that they'd fallen way behind Walmart on the digital front, to say nothing of Amazon. Now, after that quarter, we know that's no longer the case. Now, when these guys reported in May, the big problem was an earnings shortfall courtesy of higher costs. This time, Target's got its costs under control. Their operating margin came in at 6.4% when Wall Street was only looking for 5.5%. That's up 110 basis points just since Q1. In fact, Target put up its best operating margin number since the fourth quarter of 2021. When you combine the solid revenue growth with strong cost controls, they allowed the company to post a 39-cent earnings beat off a $2.08 basis. Look, that is a 43% earnings growth year over year, and that is spectacular. Of course, it wasn't perfect. Management effectively lowered its full-year same-store sales forecast within the 0 to 2% range, saying that now that they'll likely come in at the lower half. Not ideal, but keep in mind now we're already anticipating 0.1% same-store sales growth for 2024. By comparison, the new forecast is still better. Plus, even when Target revised its earnings forecast, it only did so by 25 cents at the midpoint. Not impressive, given that they just reported a 39-cent beat. As for the outlook for the current quarter, the revenue guidance came in a little light, while their earnings guidance came in a little better than expected. Fortunately, nobody got freaked out by the mixed guidance, in large part because the conference call was so darn positive. After the heinous inventory missteps of 2 years ago, Target clearly feels like it's gotten the right assortment again. I believe it, too. At a time when everyone's worried about discretionary spending, Brian Cornell noted that Target's discretionary category trends improved for the fourth straight quarter, including 3% same-store sales growth and apparel, highly unusual. In fact, their store-owned all-in-motion brand delivered, and I'm going to quote, growth in the low teens. Target's also partnered with Ulta Beauty for the cosmetics store within the store. Beauty's on fire, with 9% same-store sales growth in the quarter they just reported. That's despite coming off some difficult comparisons. How did Target do it? Like every other retailer that's thriving here, they're offering the consumer great value. Over the summer, Target cut prices on about 5,000 frequently purchased items in many markets, especially food, beverages, and essentials. Cornell says that they saw an acceleration in both unit and dollar sales trends in those businesses. By the way, that's similar to what Walmart and Costco saw. Walmart cut prices, and of course, Costco pressured suppliers to lower the prices. Now, there were other highlights, too. Target could deliver such monster margin improvement because they seem to have the theft problem under control. The gross margin saw a 90 basis point benefit from lower inventory shrink. Wow. Which is retail speak for any time merchandise just disappears. We also heard great things about their Target Circle loyalty program, which relaunched in the first quarter. They have over 100 million members, and the company added more than 2 million new people this quarter. But Cornell explained that the real goal with the revamped loyalty program was to increase engagement among existing members. And that's already happening with tons of growth for their Target Circle same-day delivery program, which we know works. We do it a lot at our company. Plus, the loyalty program lets them collect data, give you better, more personalized offers. Again, clearly working, compelling. In the end, this was a really strong quarter from Target in a tough operating environment, easily the best quarter in recent history. Not only were the numbers phenomenal, but there was a feeling that the company's in a much better strategic position. They're finally getting their assortment right and even seeing growth in categories that are supposed to be difficult right now, like apparel and beauty. They're offering customers clear value, and it's driving traffic growth. They're winning in digital, making nice progress on the theft issue, and reestablishing the loyalty program as a true differentiator. And that's why I think Target's got even more room to run. Even after the big gains last week, the stock still sells for just 16.7 times this year's earnings estimates, which represents a huge discount to Walmart at 31 times earnings or Costco at 55 times earnings. I'm not saying Target deserves the same multiple as those best-of-breed operators, but if they keep reporting numbers like these, then the stock's definitely going to start closing the valuation gap. The bottom line, Brian Cornell and his team have spent years executing a turnaround at Target, and now the comeback is finally kicking in. Even though the stock soared last week, it's way down from its highs. So I'd be a buyer right here, right now. It fits the pattern that I outlined at the very top of the show. Mad Money is back after the break.
Coming up, this segment is brought to you by the number 4. 4%, that is, yielders you ought to know about. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.